All right, welcome to the Block Research's monthly markets update. My name is Steven Zhang. I'm the research director of the Block. This month, we will be talking about surge in March trading volumes for crypto, continued success of meme coin trading, and then talk about new protocols that are seizing the hype. The second half of this presentation, which we'll be talking about the blob markets, the Dencun upgrade, and then various benefits that has led the upgrade led to rollups. And then we'll wrap this up with a Q&A session. Today's analysts will be Rebecca Stevens and Arnold Toh. Handing this off to Rebecca now.
Hi, everyone. Happy April. Thanks for coming today to our monthly market update call. Like Steven said, my name is Rebecca, and I work on the Blocks data team, and also I write our Data and Insights newsletter. And like Steven said, we're just going to be talking about some of the most important trends from the past month, including the significant rise in crypto trading in March, the continued success of meme coins, and the intention that newer protocols have been garnering. So first, just to talk about the current status of the spot Bitcoin ETFs, they proved to have another strong month overall in March. There was about $4.6 billion of net inflow into the funds across March, once again indicating that more investment was pouring into the new funds than was leaving Grayscale's GBTC, which was a trust converted into an ETF and has been continuing to see redemptions as opposed to inflows. However, inflows in March were less than the $6 billion of inflows posted in February. One reason for the lower net flow was because outflows from Grayscale picked up for a week in March. So on March 18th, Grayscale saw its largest day of outflows ever, with $642.5 million leaving the ETF, compared to only $488 million entering all the other new funds. This triggered the first full week of net negative outflows across the ETF from March 18th to March 22nd, with a total of $887 million exiting the Bitcoin ETF space. However, this did prove to be short-lived, and then after that 1 week, the Bitcoin ETFs returned to primarily having daily net inflows. The elevated Grayscale outflows were likely linked to Genesis selling off their GBTC shares, according to ETF analysts at Bloomberg. The collapsed crypto lender got approval to sell its GBTC holdings in bankruptcy court earlier this year. The heavy outflows, though, did put some pressure on Bitcoin's price, as Bitcoin fell from over $68,000 on March 18th to around $61,500 by the middle of the week. But it is worth noting that Bitcoin was already sliding beforehand, dropping from a peak of over $73,000 on March 14th coming into that new week. And then the fact that outflows continue to outpace inflows for the rest of the week, though, proved to not be as impactful, as Bitcoin was able to rally a bit after an interest rate decision by the US Federal Reserve, which signaled that 3 rate cuts were still in the cards for 2024, despite some hotter than expected inflation data earlier in the year. And also, Grayscale's outflows did slow throughout the week, though, so there was also less outflow pressure after the Fed announcement compared to like on Monday and Tuesday. But it does just go to highlight that flows aren't everything, and that there are other factors like macro sentiment and also the upcoming halving that do have impacts on Bitcoin's price. The $887 million in outflows over the course of that 1 week is much less than the typical daily volume of Bitcoin across centralized spot exchanges. Tens of billions of dollars of Bitcoin tends to get traded each day just in the spot market. So the flows themselves are actually pretty insignificant relative to the broader trading scene. However, the fact that the flows are being tracked so closely and publicly does mean that outflows can have sizable impact on sentiment, because we also saw the first sizable day of outflows from one of the newer funds last week. While primarily Grayscale has been seeing investors redeem their shares to get the value of the underlying Bitcoin, the new funds have essentially only been seeing new money pour in. But on April 3rd, ARK Invest and 21 Shares' ARK-B ETF saw $87 million in outflows, which was its first net negative day since debut. However, the Bloomberg ETF analyst highlighted that this is a normal occurrence, with Eric Blockbunoff saying the problem with the mega absurd success of these young ETFs is the standard they have set for how ETFs work. He noted that even Vanguard's S&P 500 ETF sees daily outflows sometimes, but it's not a reason to panic. It is normal for ETFs, especially as they continue to mature, to see both inflows and outflows. It wasn't really realistic that all these ETFs would continue to see new money entering forever. That being said, the two largest new ETFs, BlackRock's IBIT and Fidelity's FBTC, have yet to see days where more money comes out than in. So still some sizable investor interest. Okay, so despite that one slightly panicked week due to the heavy ETF outflows, March proved to be a great month for crypto. We saw Bitcoin break its previous all-time high set back in 2021 and trade above $70,000 for a few days. While Bitcoin has dropped from its peak, its price gains year to date are still sizable at about 62%. Ether has also had a run up this year and is up about 57% so far. Obviously, these are the two largest crypto assets, but for the most part, the bullish sentiment has been felt across many facets of the crypto space. The positive price action naturally spurred a lot more trading activity across centralized exchanges. $2.48 trillion in spot volume was traded in March, making it the fourth highest month of spot volume ever and marking the highest volume since November 2021, when Bitcoin previously hit its peak. Several exchanges saw their volumes more than double from February to March, including Binance, OKX, Upbit, and Coinbase. Binance closed the month with 45.5% of spot volume market share, its highest level since June 2023. It marks a turnaround for the exchange, which saw its market share sliding into 2024, reaching as low as 37.5% in November of last year. Part of its resurgence could be tied to the fact that the exchange settled with the U.S. Department of Justice and replaced its former CEO, Changpeng Zhao, at the end of last year, seemingly starting a new era for the exchange giant and alleviating some of the looming threat of regulatory action in the U.S. The derivatives market also heated up in March with the second highest month of futures volume across crypto derivatives platforms, second only to May 2021. Over $6 trillion of volume is traded, with the most popular venues being Binance, BitGet, OKX, and Bybit. Futures are an attractive trading tool to many in the crypto space, especially in times of high volatility. Futures offer both leverage, allowing traders to make outsized bets, and the ability to short assets, which is much less common in the spot market. The fact that crypto prices were on the rise for the majority of March attracted many more traders into the space, explaining the rapid surge across both spot and futures. That being said, part of the rise is also due to the fact that the valuation of crypto assets has climbed so much. Trading 1/10 of a Bitcoin in January compared to trading 1/10 of a Bitcoin now has a very different USD value. We can see this, for example, with the BTC USD spot pair on Binance. In February, the voluminous pair did 1.2 million Bitcoins worth of volume, or $61.8 billion worth of volume. But in March, the pair did 1.7 million Bitcoins worth of volume, or $115 billion of volume. So while volumes in Bitcoin terms jumped 40%, which is still impressive, the volume in terms of USD jumped 85% since Bitcoin was worth more. However, there's also just like no doubt in general that trading did pick up last month, which is not surprising given the current state of the market. And trading was not just limited to centralized venues. Decentralized exchanges also had one of their most successful months ever. Uniswap volume across all chains came in at almost $90 billion, which was a new high. Part of the reason it has been able to accumulate so much volume is because Uniswap has been expanding to new chains, allowing them to pick up more volume in new venues. Many Solana-based exchanges also peaked in volume, like Orca and Radium. Base as well saw its two most popular DEXs, Aerodrome and Uniswap, also peak in volume this month. DEXs on Solana and Base really took off since they offered cheaper alternatives to trading on Ethereum and oftentimes compared to trading on centralized exchanges as well. So while March marked the highest volume for DEXs across all chains, volumes on Ethereum only came in at $77.5 billion, which is actually less than their peak of $117 billion back in May 2021. So a lot of the volume for like last month came in from Solana, which did have its own high in monthly trading volumes at $60.4 billion. And while Base did also see a peak in monthly DEX volumes and has become a major source of new token listings, there was only $7.8 billion worth of trading on the layer 2 in March. So it is still quite small in the grand scheme of things. Historically, the two largest chains for DEX action have been Ethereum and BNB chain, which still saw significant volumes in the past month. But the realm of trading venues has become much more diversified. Arbitrum, Thorchain, and Avalanche have also all become more popular to trade on. But both Solana and Base saw devout meme coin communities emerge, especially since it was so easy to list new assets. Unlike on centralized exchanges, which have approval processes for adding new pairs, it's much faster to have a new token get listed on a decentralized exchange. With all of the speculative fervor and tons of like silly tokens having quick but significant pumps, there was a lot of energy going into making new coins and hoping it would be one to catch attention. So like token listings for DEXs on Solana picked up back in December, which was when the network kind of first started having a comeback. But they really exploded for Base this month. The week of April 1st saw over half of new token listings appear on Base. However, these aren't necessarily tokens of quality, which explains why Base's overall volumes are still quite low, despite seeing so many new tokens. And Solana has also been seeing a sizable amount of new listings, also being helped out by the tool pump.fun, which allows anyone to launch a token with just a name, ticker, and like an image to give the token. So while many meme coins get their fame on decentralized exchanges, they can still be quite popular on centralized exchanges. For example, Binance lists some of the classics like Doge and SHIB, but has also listed Pepe from Ethereum and WIF from Solana more recently as they have gained significant traction. One thing that seems to be true about the recent rally is that meme coin momentum does not really seem to be slowing down all that much. While obviously markets cannot be up only all the time, the major meme coins have been trending positive for the past few months. And even if growth has slowed compared to earlier in March, tokens do seem to be holding on to a lot of the gains they've made since the start of the year. On Binance, we can see that at the end of February, meme coin pairs across the board began to take up more of a share of the exchange's daily volumes. Earlier in the year, all the meme coins together weren't even making up 1% of Binance's volume. But soon there were days where Doge, SHIB, Floki, WIF, and Pepe were all taking up 1% of the exchange's volume each. While the overall share of volume belonging to meme coins peaked in early March at about 15%, meme coin popularity is still quite significant. Doge in particular continues to account for at least 2.5% of Binance's volume. And it does show that this most recent meme coin era seems to be particularly salient. While historically we have seen periods where meme coins rise to popularity, they tend to be like short-lived. While there have been some meme coins throughout this era that have had short spurts of attention, the major meme coin classics seem to be continuing to attract attention. And then towards the start of the year, there was a lot of hope for a spot Ethereum ETF to get approved. We had seen applications for these investment products come in from a lot of the issuers that also issued spot Bitcoin ETFs, most notably BlackRock, the world's largest asset manager and a firm with a proven track record of getting exchange-traded funds to market. When BlackRock filed for a spot Bitcoin ETF back in June 2023, that was a major catalyst in the shift of approval sentiment for the Bitcoin ETFs. Beyond just BlackRock throwing its hat in the ring for a spot Ether ETF, the Securities and Exchange Commission also approved Ethereum futures ETFs in 2023. And the existence of Bitcoin futures ETFs also played a pivotal role in getting the spot ETFs greenlit after a ruling in the Grayscale lawsuit said it did not make sense to block the spot ETFs for fears of market manipulation and fraud when future prices track the spot market. The ruling did make it seem like if the SEC wanted to reject the Ether spot ETF, they would have to pick a different reason than that. So with two potentially positive signals going into 2024, many were confident that approval for these new funds would come in May, which is when the final deadlines for both Van Eck and 21 Shares and ARK Invest applications are. The SEC has so far been delaying all decisions regarding the ETFs, which is not unusual for the agency. The regulator has also asked for public comment on a handful of the proposed ETFs, but ETF analysts from Bloomberg do not think that this is anything out of the ordinary, and it is not necessarily a sign of pending approval. May is now fast approaching, and a lot of the signs that showed people spot Bitcoin ETFs were set to launch soon have not been so apparent in the market. Prior to the spot Bitcoin ETFs going to market, there were a lot of meetings reported between the SEC and the ETF issuers and the exchanges they were going to be listed on. We also saw a lot of amended filings coming in as issuers and exchanges responded to feedback that they got at these meetings. We have not really been seeing much of that happening lately, although we did see one meeting between the agency and Coinbase and Grayscale in early March, but it mostly kind of seemed like a push by the two crypto firms to help convince the SEC to approve the ETFs in the first place, and not really about any application specifics. There were also concerns that the SEC can reject the ETFs for a reason beyond spot market manipulation worries, since ETH lives in a more regulatory gray area when it comes to being a commodity or a security. Many applications have also added staking provisions to allow the issuers to stake their ETH holdings and earn rewards, but it's hard to tell where these issuers will be able to do that legally, given the SEC's tough stance on staking providers that it's had in the past. So the spot Ether ETFs always seemed a little bit less like a sure thing compared to Bitcoin, which is also why some people are now just like, maybe it won't get approved in May. But with the lack of engagement from the agency and the rapidly approaching deadline, the market has shown some more hesitancy toward the May approval. Bloomberg ETF analysts have cut their prediction for May approval from 70% to 25%, citing that they have seen no positive signs that anything is coming. Similarly, the crypto market maker GSR, which in January put the chances of an Ether approval in May at 75%, has dropped their outlook to just 20%. And the predictions market Polymarket also now forecasts May approval at just 16% compared to a peak of over 80% in January. And the probability of May approval on Polymarket has been slowly declining since the market first appeared at the start of the year. But perhaps the people most excited for the potential spot Ethereum ETF were Grayscale Ethereum Trust shareholders. Much like in the case of the Grayscale Bitcoin Trust, these shareholders have no redemption mechanism, so they cannot cash out for the value of the underlying Ether. This lack of arbitrage opportunity has created a discrepancy between the price of an ETH share compared to the net asset value of the Ether a share represents. Much like was the case for GBTC, the discount from the NAV for ETH narrowed from June 2023 until early March of this year, closing from 56% last summer to just 8% last month. The gap closing showed traders were optimistic they would eventually get that redemption opportunity. However, the gap has begun to widen once again, reaching 26% at close last week, marking the largest discount since October 2023 and reversing the impact of the optimism earlier in the year. It, of course, isn't the end if the SEC does reject the spot Ether ETFs in May. It might only reject the two that come due in May, leaving the others to potentially still improve and get feedback before their final deadlines later in the year. And even if it does reject all of them, like how the agency approved all the spot Bitcoin ETFs at once, even though only one final deadline was coming, the firms can still apply again. It took several years and several tries for many of the current ETF issuers to get to the approval stage. It even took a legal battle. It's likely that the SEC will face legal battles again if rejecting these ETFs, as the potential issuers are likely ready to fight back, especially given the success that they've all seen with the Bitcoin ETFs. And analysts at JP Morgan do think a spot Ethereum ETF will eventually be approved. It might just not come as soon as next month. Okay, so now moving on to more popular protocols that have emerged recently. A new subsector of DeFi has also become quite popular, that being the concept of restaking. The idea behind restaking is that people who are staking ETH to secure Ethereum can use that to secure other third-party protocols. In a sense, it is a sort of win-win, since restakers can earn more yield, and also new protocols can tap into Ethereum's vast security network and can avoid having to bootstrap their own liquidity. The most prominent restaking platform is Eigenlayer, which has amassed over $14 billion in total value locked. The protocol really began to see its value lock take off at the start of February when the protocol temporarily lifted its deposit cap. Eventually, the restaking platform plans to abandon the deposit cap altogether, but they are in place right now while the protocol is still in its early stages. In mid-March, Eigenlayer teased its final roadmap ahead of its mainnet launch with a timeline of several weeks still ahead, demonstrating just how fresh the protocol really is. Eigenlayer is not actually supporting any third-party protocols yet, but has still become one of the largest DeFi protocols by TVL. But despite that, Eigenlayer has been a VC darling, attracting $100 million in funding from Andreessen Horowitz in their recent Series B, and $50 million in their Series A back in March 2023, which was led by Blockchain Capital and included participants like Coinbase Ventures and Polychain Capital. There's also hope for potential Eigenlayer airdrop, as the platform does deal out restaking points right now for early restakers. On Eigenlayer, users can deposit liquid staking tokens like STETH or CBETH, or they can also natively restake ETH if someone is not staking via a liquid staking protocol. As of right now, native restaking is the only method open to get funds into Eigenlayer, as deposits are halted for LSTs. But either way, if you use Eigenlayer directly, you do not get a liquid restaking token, meaning your funds are locked up. This has created a new genre of protocols, the liquid restaking protocols. These protocols all use Eigenlayer to achieve their restaking aims, but additionally provide depositors with a liquid restaking token, allowing them to maintain liquidity, similar to how liquid staking protocols give depositors a staking derivative token. Liquid restaking protocols have amassed over $8 billion in value locked and have also had some sizable raises. Another potential benefit from going through a liquid restaking platform is, again, the potential for an airdrop. The largest liquid restaking platform by TVL, EtherFi, announced its airdrop last month. but also boasts about how many eigenlayer points it has garnered across its deposits, hinting that users might also get part of the eigenlayer airdrop once it happens, or if it happens. Restaking is becoming the more popular option, it seems like. Since March 23rd, over 40% of new daily validators have been restakers, with that share reaching 85% some days. Again, it is still very early on for restaking, and yet it seems to have become the de facto option for new users looking to secure the Ethereum network. So it does seem like there's a lot of space to grow, but it will be interesting to see how many protocols adopt Eigenlayer's shared security network once its mainnet goes live. Another new protocol that has been getting some attention is Athena. Athena is the issuer of the new USDE stablecoin. Unlike USDT and USDC, the two largest stablecoins, it is not fiat-backed. Rather, it is backed by both a long and short Ether position, with the long position taken by staking Ether and the short position taken via a perpetual futures contract. The peg is held by the use of hedging the derivative position against the held collateral. So basically, it's just like if the value of ETH goes down, then the value of the short position goes up and vice versa. It's essentially a tokenized version of the cash and carry arbitrage strategy that occurs across all markets. The USDE stablecoin position does generate yield, both by the staking rewards generated on the staked position, as well as on the perpetual contract for now. Basically, like the way like perpetual futures contracts work, is they have to have a funding rate to keep futures prices in line with index prices. So like funding rates are like periodic payments that are made either to traders that are long or short based on the difference between the perpetual contract markets and the spot prices. So when the funding rate is positive, the price of the perpetual contract is usually higher than the market price for the asset. And then the traders who are long pay for the short position. So for most of crypto's history, funding rates have tended to skew positive. So for Athena, they can also get paid for their short positions as well. But in order to tap into the yield generated by the USDE backing, users need to stake their USDE positions and get SUSDE, which is just like the staked version of the stablecoin. The Athena website currently boasts a 37% APY for SUSD. Naturally, this has made the stablecoin quite popular. The project launched in stealth back in December and had a public mainnet debut in February and has already amassed a supply of over 2 billion USDE, making it the fifth largest stablecoin by market capitalization. Athena did an airdrop of 750 million tokens to early adopters at the start of April after awarding shards to users for engaging with the protocol. Shards are basically like kind of points on Athena. But surprisingly, the sharpest rise in USDE growth supply came after the airdrop, with the supply growing by over 400 million from April 1st to April 3rd. Athena Labs did announce its airdrop season 2 on the 1st, though, which could explain the surge as airdrop farmers piled in to get ENA tokens in the next round. Of course, with such high yields, some people are skeptical of whether this protocol has a sustainable future. For one thing, Athena now holds over 10% of all open interest on ETH perpetual contracts already. One of the red flags in the short open interest accumulation on Athena's end is that it will push the yield generated by USDE down, as it could lower the funding rates for ETH perpetuals as like short positions begin to accumulate, or even turn them negative in an extreme case. However, so far that has not happened, but could become a more tangible threat if demand for the stablecoin continues. But what could happen is that a lower yield in the wake of lower funding rates just like dwindles demand for USDE, finding a sort of equilibrium for how much of the futures market Athena can realistically handle. There are also concerns about general market manipulation and concentration risk as Athena begins to control more of the market. The protocol recently added Bitcoin as a backing asset to help address this concern, allowing it to diversify its portfolio somewhat. There's also the risk that sizable redemptions puts Athena in a position where it has to make unfavorable trades with like large spot sales and also like buying up a lot of long futures. But there is a 750,000 USDE limit on both issuance and redemption to try and help mitigate this. And then there are also just some counterparty-esque risks, like Athena keeping some of its reserves on centralized exchanges, and also on institutional custodians like Copper, and also the fact that Athena holds liquid staking tokens, which could falter if their liquid staking protocols face issues. But despite the concerns, Athena Labs has been really like the talk of the town, and it also raised $14 million in a round co-led by Dragonfly and the family office of the BitMEX co-founder Arthur Hayes, giving the developer a $300 million valuation. Also, MakerDAO, the issuer of the crypto-backed stablecoin DAI, is weighing a proposal to allocate $600 million of DAI into USDE and SUSDE. with interest in the proposal driven both by the yield opportunity and the potential to earn ENA tokens. The proposal, which in a sense kind of gives a green light to Athena and USDE as a concept by MakerDAO, also has the potential to allocate more than the $600 million limit to the newer stablecoin. But not everyone is happy about this prospect, with many in the Aave community taking to X to criticize how risky that move would be, and even going so far as suggesting a loan-to-value deduction of DAI in the lending protocol. So community opinion does seem to sway either very positive or negative for USDE, but time will tell how the protocol is able to adapt to potential scaling pressures ahead. And if you were at our February call, then you might remember that we talked about Farcaster, which first exploded in popularity at the end of January with the launch of a new feature called Frames, which allowed for interactive experiences like games, to NFT minting, to movie watching, to be embedded within posts called casts on the decentralized social media platform. But Farcaster was not exactly a new protocol when Frames launched. The platform opened up to all users in October 2023 after having limited access beforehand. But it had not really taken off. So it kind of begged the question of whether the new wave of hype ushered in by Frames would be sustainable. Especially, for instance, we saw Friendtech, which was another decentralized social platform, which had kind of a different concept than Farcaster, but still a similar idea. It kind of faded into obscurity after having extreme success over the summer. At first, it seemed like maybe Farcaster's initial bout of success was unsustainable. Both daily activity and daily users hit a peak in early February and then began falling into early March. Usage levels did manage to stay much higher than they were pre-Frames, but it seemed like the levels of excitement brought on by Frames initially were not really holding. However, at the start of March, things began to turn around and both posting and reacting activity, as well as the number of users, began to pick up again. And then before the end of March, Farcaster had hit a new daily high for the number of casts. And by early April, it had reached a new peak for the number of users casting and reacting to those casts. And the numbers kept going higher. Over 957,000 casts were posted on Farcaster on April 5th, more than tripling the peak seen in early February. And there were also almost 2.5 million reactions to those casts that day as well. Similarly, the number of casters reached 50,000 this month, also blowing past the February high, but to a lesser extent. But more people on Farcaster bodes well for Farcaster, since it is sort of an attempt at an X or Reddit alternative social media. So a core component of what makes a social network valuable is the users. So even people just signing up for Farcaster during the Frames hype back in February is a pretty good signal, since it means that at least you have access to the account and you can just decide to start posting on Farcaster if you want to. So the broader user base did help it catch on and kind of stick on. Another benefit to Farcaster is the fact that accounts are linked to on-chain wallets. This has made community rewards somewhat simple. For instance, the memecoin DGen that is quite popular on Base was initially airdropped to all members of the DGen community channel on Farcaster. It's harder to do an airdrop to all your followers on X since you don't really know everyone's address. But on Farcaster, it is easy for users to reward loyal fans or community participants on the blockchain. So part of the Farcaster resurgence could be tied to more people attempting to use the platform to farm potential airdrops. But even if it is just airdrop speculation, it does seem to have found some sort of product market fit, at least for now, while it's primarily catering to the crypto community. The developers of Farcaster and its most popular client, Workcast, Merkle Manufactory, are also reportedly about to complete a funding round that would give them a $1 billion valuation led by the crypto VC paradigm, which does also seem to serve as a positive signal for the platform going forward. So just to recap everything we just talked about, the flows in and out of the spot Bitcoin ETFs continue to have an outsized impact on market sentiment, as we saw with the week of Grayscale outflows. But in general, the ETFs still seem to be attracting new interest for the most part. Trading both on and off chain and in both the spot and derivatives market exploded in March, driven by the bullish sentiment in the crypto market, attracting in new traders and helping bolster USD valuations. We have also seen Ethereum's decentralized exchange dominance wane as cheaper networks like Solana and Base begin to attract loyal fan bases. Memecoins have continued to be a successful crypto subsector, still accounting for a higher share of trade volume on exchanges compared to earlier in the year. And many newer protocols have been seeing a lot of early stage success, like the entire restaking subsector with Eigenlayer and the liquid restaking protocols, Athena's USDE stablecoins, and also Farcaster's continued popularity post-Frames. And with that, I'm going to pass it over to Arnold, who is going to talk to you guys all about the impacts of the Ethereum Dencun upgrade. And don't forget, if you have any questions, to put them in the Q&A box.
Thank you, Rebecca, for sharing with us market updates. And yeah, just another quick reminder to send your questions in. So my name is Arnold, and today I will be presenting on the Dencun upgrade as well as the state of data block markets, where we will be covering the impacts of data blobs as well as looking at the L2 data costs as well as their revenue post Dencun upgrade. So we start by looking at the Dencun upgrade, right, which has brought data blobs, which is a cheaper method of posting transaction data on Ethereum. It has brought that data blobs into production. And ever since the upgrade went live on March 13, there have been over 27,000 blocks that have already have data blobs attached to them. This represents like an average utilization of around 27.4%. And what this means is that roughly 27.4% of all the blocks that have been finalized on Ethereum since the Dencun upgrade have had data blobs attached to them. So we do see that the hourly utilization rate has has a great variance with a minimum of 4.7% and a maximum of 75.9%. But this just means to say that ever since the upgrade went live, within any given hour, there were blocks that have been finalized on Ethereum that had data blocks attached to them. So the most notable impact from the Dencun upgrade would have to be the decrease in the L2 gas fees. And these L2s are those that have utilized data blocks for storing their transaction data. We do see notable drops across the board, especially for large optimistic rollups like Arbitrum and Optimism, with declines of ranging from 80 to 90%. And although the Dencun upgrade has helped to alleviate the gas costs on layer 2s very significantly, it does not actually fundamentally solve the problem of meeting ad hoc demand for block space. And this can be observed from periodic spikes post Dencun upgrade, both on base as well as darknets, where you see periods of elevated gas fees even after the upgrade. So we do see that layer 2s such as Linear that did not immediately utilize data blobs post Dencun upgrade, also noticing significant declines in their gas fees. And this is partly due to the fact that the gas expenditure of layer 2s have dropped across the board, and that has actually caused a spillover effect to the general Ethereum ecosystem, which we will discuss later on. Yep. So now we look at the state of block markets, and here we have the charts for the number of blobs by blockchains, by layer 2s, as well as the number of block transaction. So the number of blobs that layer 2s have data blobs that layer 2s have been posting have steadily increased over time, with the exception of Starknet's outlier on the very first day that Dencun went live. Most other layer 2s have been witnessing a steady uptrend, and this just goes to show the increased adoption of data blobs across most layer 2s. We do see that the greatest usage of data blobs seems to come from the three largest optimistic rollups, namely Arbitrum, Optimism, as well as Base. Meanwhile, ZK rollups like Starknet as well as ZK Sync Era seems to be lagging behind in terms of the data block utilization. And this actually is a little peculiar since data blocks actually carry transaction data. So technically speaking, we should see the same level of adoption across ZK rollups and optimistic rollups, but it turns out that optimistic rollups are seeing a lot more demand for their users in the past few weeks. And here we have the chart that shows the number of blobs per transaction that each layer 2 have posted. And this is a very succinct chart that can show the utilization of data blobs across layer 2s. Because the maximum number of data blobs that can be attached to any single block is 6. So the closer a layer 2, the closer the layer 2, the data blocks that layer 2 posts that is closer to 6, the more heavily utilized, the more it's heavily utilizing data blocks. And from this chart alone, we can see how Arbitrum is clearly in the lead, and Optimism as well as Base are very close competitors. And you can also very quickly tell that across the ZK rollups, ZK Sync era is definitely way ahead of the competition. But despite that, all the ZK rollups still pale in comparison to optimistic rollups in terms of the number of data blobs that they are posting on chain. Right, and as I mentioned earlier, right, the impact of data blobs cannot be understated because it has actually reduced gas expenditure across layer 2s by over 93% over the past 3 weeks. And this reduction in gas expenditure has also an impact on the broader Ethereum ecosystem, because now the layer 2s that have previously utilized all of this gas, they no longer compete because they're no longer using as much, so they no longer compete as hard with the rest of the broader ecosystem for block space as well as computational resources. So as a result, we do see other layer 2s such as Linear, as mentioned earlier, having a decline in their gas fees over the same period of time that layer 2s have started implementing the use of data blocks. And then now we move on to layer 2's data cost as well as their revenue. This one is really interesting because we do see how the Dencun upgrade has significantly affected both the data cost as well as their revenue. So in terms of data cost, we do notice that there's a huge decline in the data fees that have that layer 2s are paying post upgrade. And it seems to be that Scroll is now the largest spender on data, sorry, on transaction data. And this is reasonable considering the fact that Scroll has yet to adopt data blocks and is still using core data for posting transaction data. And what this also means to say is there is a potential for Scroll to further reduce their data fees when they do implement, when they do start adopting the use of data blocks. But in the general trend for most other rollups, here has been a significant decline of more than 90% across the board. And this has also been reflected by a corresponding decrease in the median gas fees for users on layer 2s. However, there is a flip side to the Dencun upgrade, right? Which is reducing data costs and the corresponding reduction in layer 2 gas fees have resulted in a decrease in the revenue for many of these layer 2s. We do see how both Arbitrum and Optimism having significant drops in their revenue after the upgrade on the 13th of March, as can be seen from the chart on the right. And it appears that the only rollup that has continued having an uptrend in its revenue over that same period of time is Base, whereas even the other ZK rollups have also witnessed like a reduction in revenue. So yeah, it seems that Base is the only rollup here that has come out on top in terms of the revenue post Dencun upgrade. And if we were to subtract, the data cost from the revenue, we can get the estimated daily profits for layer 2 operators. And clearly, as I've mentioned earlier, Base has been very profitable over the last few weeks, averaging over 700,000 in daily profits over the past close to a month, not the full month. But there's been something that is really ideal for Base, obviously. But it remains to be seen if this trend continues, as we do notice that the profits have started to decline in the recent weeks, in the recent days. So that trend may continue over time. That said, most other L2s in the space are still highly profitable in terms of their operation. Both Arbitrum and Optimism, they're still generating 66,000 and 60,000 on average in daily profits. So as long as they are still coming out in the green, like it would stand to reason that they would continue to operate the L2s optimally. However, there is a peculiar there's something to note in this analysis, which is Scroll being a much smaller rollup, averaging more at 120,000 in daily profits over the same time period. And this is despite the fact that both Arbitrum and Optimism have had more transactions on chain than Scroll. So this means to say that despite having fewer transactions, Scroll is still coming out as a more profitable rollup than larger rollups. And this could be because of not implementing the Dencun upgrade, not adopting data blobs. So what this means to say is that the use of data blobs could actually decrease revenue more greatly than it does decrease in the costs that L2s incur for posting transaction data. So this would be something that we should keep an eye out for, of whether or not rollups decide to adopt data blobs over the next few weeks. Yeah. And with that, we come to the key takeaways, right? We noted that Dencun Upgrade have significantly reduced the gas fees on layer 2s, over 80 to 90% decrease in median gas fees for most of the layer 2s after implementing the use of data blobs. And we also start to notice that data blobs having heavier utilizations from layer 2s, although the usage stems primarily from the larger optimistic rollups. But we also do see ZK rollups using data blobs just to a much smaller extent. And the impacts of data blobs is not restricted to just layer 2s, because the reduction of gas expenditure of layer 2s on Ethereum does free up computational resources that other dApps and users can now, that can be allocated to other dApps and users on Ethereum now. And last but not least, layer 2s still remain highly profitable to operate even after the upgrade, with Base being the prime example of how they can still generate record high daily revenue even after this upgrade. But most rollups have witnessed a significant drop in their revenue. That said, all of them have remained profitable. So this is, I'm sorry, yeah, most rollups have remained profitable even though their revenue has dropped. And utilizing data blobs, as mentioned just now, may not necessarily be a very profitable move for L2 operators based off the data point of Scroll. So we will have to keep an eye out for that. And yeah, with that, I've come to the end of the presentation. We will answer any questions that you guys have.
Yeah, so we have a list of questions. We'll start off with Rebecca, but feel free to continue asking questions as we go through them. First question, what is the business model of EigenLayer? How does it make money?
Yeah, so right now, EigenLayer's business model will really start to take shape once it does launch its mainnet. It will take a cut of the fees that it charges to the third-party networks that it secures, kind of similar to how staking protocols now take a cut of the staking rewards earned. But for right now, they're it's not really making money. It's just kind of attracting this large user base. So that way, when they do launch their mainnet, it will be really attractive for third-party networks to want to use EigenLayer.
Great. Next question. What are other competitors to EigenLayer?
So definitely like if you go to like DeFi Llama right now and go to like the restaking category, Eigenlayer is like the largest restaking protocol by like a really long shot. So it definitely does seem to be the main restaking protocol for Ethereum, which like is also just like the largest proof of stake network. But a competitor called Karak actually just like launched today, but obviously it has a while to go before it catches up to the size of Eigenlayer. It's also possible that like if restaking catches on as a concept for Ethereum, that like other proof of stake networks also begin to see like other restaking protocols emerge, and there could be like room for a new dominant player on different proof of stake chains.
Great. Next question. How does Athena USDE work to maintain its peg? Does the protocol hold stake ETH and ETH futures?
Yeah, so basically it is exactly that. The protocol does hold staked ETH and ETH futures. And it's kind of like a hedged position. So like you have the staked ETH and the short ETH future. And so if the price of ETH goes up, then the value of that staked ETH goes up. But the value of the short position then goes down. Similarly, if ETH drops in price, then the value of the short goes up and the value of the staked ETH goes down. So you kind of like have a delta neutral hedge, and you kind of like price out like you kind of are like unexposed to market volatility. So it should just like make it a neutral position to hold and be able to hold the dollar peg.
Great. And last question for Rebecca. Would you have any thoughts on the upcoming Bitcoin halving?
Yeah, so I'd say in terms of like price action, like the sentiment is pretty mixed. Like we did see Bitcoin already reach a new all-time high earlier this month, which some say is a signal that the Bitcoin halving is already priced in, because obviously it's like it's an event that we know is going to happen. So like you get this concept of like, oh, is the market already like prepped for it and is already like completely expecting it, and like nothing will actually happen when the halving happens. But then of course you also have like the fact that like these new Bitcoin ETFs have attracted a lot more interest into Bitcoin, which could mean like that this new all-time high was just like spurred by these ETFs and like better market sentiment. So maybe the halving is actually like not priced in, because there's like maybe not as many people talking about it as you'd think. So like for price action, it's kind of like a mixed bag, and I would say like the halving is coming up like later this month, but like there's also a lot of questions about like how macro sentiment also weighs on the price of Bitcoin as well moving forward, like whether the 3 rate cuts still stays true as we go further into the year. And then also just like in terms of like other things, obviously miners will be making less money. So they might be more inclined to sell in the wake of the halving as they like try to like have like actual cash on hand.
All right, I think that's the end of questions for Rebecca. We're gonna move to questions for Arnold. First question, the transaction fee for layer twos are already really cheap. Was the Dencun upgrade necessary?
To answer that question, I would say this is just like my opinion, but I think yes. Obviously we know that layer 2 fees were already cheap, but the whole idea of having data blobs was so that layer 2s can leverage an alternative mechanism to post transaction data that doesn't clog up the blockchain for Ethereum users and Ethereum DEX. So the idea that asking whether or not it's necessary, it's obviously you could argue the flip side that like it's not needed per se, but I would say that it does generate, or it does create a better user experience for the entire Ethereum ecosystem. So I would lean more to the side of yes.
Great. Next question. Do rollups as a service RAS also support blobs? Do you have any recommendations for RAS?
Well, okay, so the first part of the question, do RAS also support blobs? Yes, they can. Although we haven't really seen any RAS come forward with that announcement that, from now on, all of our rollups will support blobs. This should primarily be because of the fact that when you launch a RAS, there are parameters that you can adjust. So I believe that even when RES starts supporting like data blobs I mean, RES probably already support data blobs. The main point of like the gatekeeper is still the deployer of the rollups, whether or not they choose to adopt data blobs. So I hope that answers the first part of the question. They can, but the choice lies in, the deployer. Do I have any recommendation for RES? I would say the most notable one that comes to mind right now is Altlayer, because they already have a token, but there are notable contenders without a token, such as Caldera and Conduit. They do allow users to deploy very easily. It's a similar experience to Altlayer, right? But obviously the one with a token always tend to stand out more. But just based off like user experience alone, because I've experimented with these applications, they do have slight differences in their interface, but all of them are pretty easy to navigate.
Great. How do blobs? How blobs can ensure the data integrity on Ethereum?
Yeah. So this question is going to get a little bit technical, but for one, blobs don't ensure the data integrity on Ethereum. Like it is the commitment, the hash of the commitment that is being carried in the transaction that does. So to put it as simple as I can, the data in the blob itself has a certain commitment. I think it's called the KZG commitment, and that just basically represents the all the transaction data that have been posted in the block. And then the hash of this commitment is now posted on Ethereum. So any Ethereum transaction, any Ethereum block that has this commitment is basically a data block carrying block. So the presence of that hash of that commit of the block is what ensures the data integrity on Ethereum. So I hope that answers your question.
What does the user experience look like when the user can choose a blob type of transaction? Yeah, this might be a confused question.
Yeah, I mean, there should be no difference to the end user. It won't be there won't be any difference. I think only after we look at rollups decentralizing their sequencer nodes, then the sequencer nodes might be able to play around with how they want, whether or not they want to use data blobs when posting the transaction data on chain. Yeah, at that point in time, then this question might make more sense. But for now, like there is no degree of control the user has over a block type transaction.
Great. What is Base doing differently that they have so much profits compared to other layer twos? Was there a particular spike in their activities recently?
I'll answer the second part of the question first because it's easier. The answer is yes, because there have been like memecoins as well as NFTs that have just been taking off on Base. So yeah, there have been a particular spike in the activities recently. But what Base is doing differently, I mean, to be very frank, I would wish I had the precise answer to that. But my guess is for now, because layer twos are essentially a smart contract on layer one on Ethereum, right? So they do have certain control over how much gas they charge their users. So it is hard to tell until they open source their their operator node software, which I don't think they would ever, or at least not in the foreseeable future. But only when they open source that code that it will be possible to tell just how much degree of control they have over tweaking the gas parameters on layer two. So if they choose to, not decrease or their gas charged on layer twos by the same proportion that their gas that their data fees that they paid have decreased, then yes, obviously they can stand to make a lot more. But this is just speculative. I don't have a precise answer for this question. Yeah.
Great. What are some other layer threes that the team is tracking? Are there any teams building layer fours?
Right. So in this question, layer threes generally, I would say that broadly, we haven't been tracking it a lot because the layer threes don't really have much hype around them yet. But it also kind of depends on how you define layer threes, because layer threes, if you're defining them as on ZK rollups, those rollups that use additional recursion, then yeah, we don't see many of them. But if you're just talking about layer threes as a general abstraction of execution layers, so you could talk about like things that rollups that have deployed on Dimension as layer threes, right? Like it's really difficult. Like I don't really like to go into the technicals of how we define layer threes and layer fours. So in my opinion, like I tend to just view projects as more of like whether they are an execution layer, whether they are a consensus layer or settlement layer. That would make it a lot clearer, because once you start talking in terms of the layer threes and fours and fives, yeah, then you kind of have to introduce the whole ZK proof recursion mechanism inside, and that can be very confusing. When does it count as a layer three? When does it count as a layer four? Yeah, so in general, if you're talking about layer threes by ZK proof recursion, no, there hasn't been much activity that we are tracking. But if you're just talking about like execution environments in general, there are a few like things that have deployed on OP chain would count. Things that have deployed on Arbitrum AnyTrust would count. These are all execution environments that have just been abstracted from a framework. So yeah, in those aspects, there's definitely more activity than in terms of the ZK rollup layer threes and fours. Hope that answered your question.
The Dencun upgrade and multiple layer twos have made transactions on ETH cheaper, but does not solve for fragmentation of liquidity across these different layer twos. Solana is dominating in terms of UX fees and liquidity. Any thoughts on this?
Yeah, so I would say that in general, Solana does beat the layer twos in terms of this in this UX issue when we talk about fragmentation of liquidity. And this is very apparent from the amount of liquidity that have been pulled on layer two bridges. So like across Stargate, a lot of these EVM bridges that have a lot of liquidity that comes from layer twos. This just goes to show how much liquidity is actually being allocated to facilitating cross layer two bridge transactions. My own personal thought, obviously, is I do think that this is a problem that should fade over time as the bridging experience become more seamless, so that you can just bridge and interact with an application on layer twos. But that is still a far future, and obviously in the meantime, Solana can cement itself as the market leader and just prove that layer twos aren't really as great as they make it out to be. Obviously, I'm rooting for layer twos, but just looking at the facts of the matter, Solana does provide very strong competition for layer twos, especially since gas fees, the transaction fees are both equally cheap. Both are equally centralized. Okay, it depends on how layer twos are actually a bit more centralized than Solana if you were if you were to think about it carefully. So I would say right now Solana does come out on top of layer twos. But yeah, only time will tell if layer twos can win because right now the only thing that's carrying them is mainly just the whole EVM experience, as well as the Ethereum as the underlying settlement layer. But yeah, I'm not a prophet. We will see if Solana comes out on top in the future.
Great. Next one might be the last question. The blobs expire in a week or two, I think.
Yeah.
How does the block hash proof work?
Right. So the blobs themselves expire in 2 weeks on an Ethereum node, but the commit remains there. So there are archival nodes that do store this data, but it's a lot more expensive and requires a lot more computational resources to run. So there are much lesser of them. Obviously, this means that the degree of security does dip a little, because the data isn't as readily available as you would expect it to be in 2 weeks. But in general, it's still sufficiently decentralized that the general Ethereum community has they are okay with it. So if you do need to prove the block hash, you can still query the data from a full archival node, but it would probably not be as readily available as data that is within the last 2 weeks. So I hope that answers your question.
Great. Yeah, I think that's the end of list of questions. As a reminder, this call is recorded, and the slides will be the recording and the slides will be published on the Block's research portal by the end of the week. Thank you everyone for attending, and have a good day.